In this deep dive, we're unpacking a really detailed structural flowchart and a comprehensive training module to decode this massive, complex world of project finance.
And our mission here is to break down how these massive infrastructure projects, airports, toll roads, power plants, how they actually get funded.
Right, and we're going to do it using simple everyday analogies so you won't even need a finance degree to understand it.
Which is good because it can definitely get pretty dense.
Oh, for sure. So let's just set the stage by comparing it to a normal corporate bank loan. Like, say, a successful regional bakery needs a new industrial oven. The bank looks at the whole company, right?
Right. They look at the past pastry sales, the value of the storefront, the owner's credit history, all of it.
Yeah. And if that bakery defaults on the oven loan, the bank doesn't just take the oven. They can take the delivery vans or even the storefront itself.
Exactly. The debt sits squarely on the parent company's balance sheet, but project finance is just entirely different.
It really is. The training module points out that the lender looks only at the specific project, like they evaluate it in a total vacuum.
Yeah, they are looking exclusively at the future cash flows of that one offshore wind farm.
Right. And if the project goes bust, the bank cannot touch the parent company's other power plants. They can't access their corporate bank accounts at all.
Which, sounds like a terrible deal for the bank on the surface. To make a financial institution accept that level of isolation, you need an immense amount of legal structuring.
And that structuring is actually right in the middle of the flow chart we're looking at today. There's this big purple box dead in the center.
Ah, yeah, the SPV, the special purpose vehicle.
Or the project company, as it's sometimes called. There's this huge web of contracts just radiating out from it. It looks like a legal quarantine zone.
That's a great way to put it. I mean, the SPV is a legally distinct entity. It has no history, no other business, no other assets.
Its only purpose in life is just to execute this one specific project.
Right. It holds the permits, signs the construction contracts, and borrows the money. That's literally it.
So to make this crystal clear for you listening, the source material uses this really great annex analogy.
Oh, yeah, the annex analogy is perfect for this.
Right. So imagine you own a really nice large house that's your main company, and you want to build a massive new annex in the backyard, which is the project.
And if you expand your current mortgage to pay for the annex, you're putting your main house at risk.
Exactly. If the annex project goes massively over budget or just falls apart, the bank could potentially foreclose on your entire property. You lose your main house.
So instead of doing that, you set up this SPV. You basically create a brand new limited company just to own the annex.
Right. And its mortgage is secured only against the annex itself. So if the annex catches fire and burns down, your main house is completely safe. The bank just gets the ashes of the annex.
Exactly. It completely avoids that cross-contamination. And this isolation is huge for the parent companies, which the flowchart calls the sponsors.
But the sponsors aren't just getting a free ride, right? They still have skin in the game.
Oh, absolutely. They own the SPV and govern it through a shareholders agreement. And they have to inject their own money first.
Right, the equity, which is usually, what, 20 to 30% of the cost?
Yeah, typically 20 to 30%. So on a €2 billion wind farm, the sponsors are putting up maybe €500 million of their own cash.
Wow. Which is still a huge commitment. And if the project fails early on, that equity just gets totally wiped out before the lenders lose a single cent, right?
Exactly. The sponsors take the highest risk position, but the upside is that if the project succeeds, they get all the remaining profit after the debt is paid off.
Okay, so they cover 20 to 30%. Right. But that leaves a massive funding gap. You still need 70 to 80% of the money.
Right, and that's where the lenders come in. This is usually syndicated loans from commercial banks or multilateral banks like the European Investment Bank.
Or export credit agencies, the flowchart mentioned.
Yep, and they provide this massive influx of capital as what's called non-recourse debt.
Okay, wait. Non-recourse, meaning the lenders have absolutely zero recourse to the parent company.
Exactly. If the project goes bust, lenders can only seize the project's assets, the turbines, the land rights, the SPV's contracts.
But wait, so the bank just says, oh, well, we lose €1 billion if it fails. I mean, that sounds insanely risky for the bank. Why would they ever agree to that?
Well, they don't just blindly accept it. Pure non-recourse debt from day one is basically a myth.
Ah, okay. So there's a catch.
Yeah. In reality, it's often limited recourse during the construction phase, because construction is when the capital is bleeding out and zero revenue is coming in.
Right. That's the riskiest part. So how do the banks protect themselves then?
They demand completion guarantees from the sponsors. So if costs overrun while they are pouring the foundations, The sponsors are legally obligated to inject more equity to finish the job.
Okay, so the parent company is on the hook to at least get the thing built.
Exactly. But once the project is fully operational, turbines are spinning, cash is coming in, those guarantees fall away. Then it becomes truly non-recourse.
Right. But even then, being trapped in a loan with a single asset company for 20 years, lenders must demand a crazy amount of collateral.
Oh, they do. To compensate for the risk, lenders take this massive security package.
Yeah, the flowchart shows a security trustee managing all of this. What does that actually look like in practice?
It means the banks literally lock down every asset, every contract, and every single bank account the SPV has.
Wait, they control the SPV's bank accounts?
Essentially, yes. If the SPV mismanages things or starts failing, the lenders have step-in rights. They can fire the management team and bring in a third party to run the wind farm to get their money back.
Wow. Okay, so they have a total stranglehold on the operations. But since they're trapped inside this legal SPE box for repayment, they still need to know for sure that the box will actually make money.
Right, they need mathematical certainty. Which brings us to the most important number in all of project finance.
Yes. The debt service coverage ratio, or DSCR. The training module focuses so much on this.
It really is the magic number. It measures the cash the project generates against the debt it owes.
Okay, let's use the toll road example from the source to break down the math here.
Perfect, yeah. Let's walk through it.
So imagine you have a toll road. It makes 18 million euros a year from drivers. But you have operating costs, toll booth staff, maintenance, insurance, which costs 6 million.
Right, so 18 million minus 6 million leaves you with 12 million euros.
Exactly. That 12 million is your cash available for debt service, or CFADS. Now, let's say your loan repayment and interest for that year equals 10 million euros.
Okay, so you have 12 million in cash and you owe 10 million in debt.
Right. So 12 divided by 10 is 1.2. Your DSCR is 1.2x.
Exactly. And what that 1.2x actually means is that the project earns 20% more than it strictly needs to survive.
That extra 2 million is just the cushion.
Right, and lenders love a cushion because a DSCR of 1.0x means you have zero margin for error.
Yeah, if traffic dips even slightly, you can't pay the bank.
Exactly. And anything under 1.0x means you are in active distress. So if the ratio drops, say to 1.1x, the lenders activate a lockup.
A lockup, like nobody gets paid.
Well, the bank gets paid, but the sponsors get zero dividends. The bank traps all the excess cash inside the SPV until the ratio recovers.
Wow. Okay, but wait, let's go back to that 18 million in revenue. How do you guarantee that a toll road or a wind farm will actually make that much money every year for decades?
You can't just hope the free market will buy your power. You need absolute certainty. So you bring in an off-taker.
An off-taker. This is in the bottom section of the flowchart. Who is the off-taker?
It's basically a highly creditworthy party like a government or a massive utility company that signs a long-term contract agreeing to buy the output.
Oh, like a power purchase agreement or PPA?
Exactly. Under a PPA, the utility agrees to buy every single megawatt of electricity that wind farm produces at a fixed price for like 20 or 25 years.
Wow. So they eliminate the price risk and the demand risk entirely. The lenders are basically looking at the off-taker's credit score, not just the wind farms.
That is exactly it.
Oh.
Without an off-taker to guarantee that revenue, the lenders simply walk away. They won't fund it.
Makes total sense. Okay, so we have the money from the lenders, we have the buyer guaranteed by the off-taker. Now we have to actually build this massive structure without going over budget and ruining our precious DSCR.
Right, which is terrifying because construction is chaotic. But the training module has a really clear philosophy for this. The golden rule of project finance.
The golden rule. Allocate every risk to the party best able to manage, control, or absorb it.
Yes. If a risk isn't allocated properly to the right party, again, the lenders will just walk away.
And the SPV is just a financial shell company. It can't pour concrete or weld steel.
Yeah.
So it can't handle construction risk.
Exactly. So it transfers all of that risk to an EPC contractor. That stands for engineering, procurement, and construction.
Right. And the source material talks about how lenders demand these fixed price, lump sum, turnkey contracts.
Turnkey is the key word there. It's a massive risk transfer.
I love the car buying analogy for this. Like when you go buy a new car, you don't pay one guy to design the steering wheel and then negotiate with another guy to source the tires and just hope they all fit together in your driveway.
Right. That would be a nightmare.
Yeah. You just pay a single fixed price to the dealership and they hand you the keys to a working car. You just turn the key, That's a turnkey contract.
That's exactly how an EPC contract works for a €2 billion wind farm. The contractor promises to deliver a fully operational facility for one guaranteed price.
So if steel prices suddenly double, or digging the foundations is way harder than they thought, the contractor just has to eat that cost.
Yes, the contractor absorbs the financial loss. The SPV and the lenders are completely protected from those cost overruns.
But what about schedule delays? If the contractor is a year late finishing the wind farm, you have a year with no revenue, but you still have to pay back the bank loan.
Right, delays will destroy your DSCR just as fast as overruns. So the EPC contract uses liquidated damages, or LDs.
LDs, these are basically massive fines, right?
Yeah, severe financial penalties. If the contractor is late, they pay a pre-calculated fine for every single day of delay.
And that fine is mathematically linked to the project's debt payments, right? So the FBV uses the fine money to pay the bank.
Exactly. It covers the missing cash flow. There are also performance LDs. So if the wind farm is built on time, but it produced 10% less power than promised because of a design flaw, the contractor pays a huge penalty for that too.
Man, taking on that much liability, the contractor must need a very specific airtight contract.
They do. And the module specifically points out the FIDI Silver Book as the gold standard for these EPC contracts.
The Silver Book, why is it the gold standard?
Because it maximizes the risk transfer away from the SPV and directly onto the contractor. It has super strict rules that say, basically, if you find unforeseen problems like bad bedrock, that's your problem, contractor. You pay for it.
And lenders must love seeing a FIDI Silver Book.
Oh, they do. It means the construction risk is totally locked down.
So zooming out and looking at this whole elegant web of project finance, it's really not just a loan at all. It's an entire ecosystem.
Yeah, it's a completely interdependent system of contracts.
Right. You have this SPV sitting right in the middle, totally shielded from the parent company. It's funded by lenders who are relying entirely on the off-taker's promise to buy the power and the EPC contractor's promise to build it perfectly on time.
Every single party is holding a very specific, carefully negotiated piece of the risk. That's how you make a €2 billion project possible.
It's honestly a brilliant piece of financial engineering. But, relying on this incredibly rigid ecosystem of contracts for 25 years, it does bring up a really provocative thought to end on.
Yeah, the long-term vulnerability of all this certainty.
Right. We've talked about how this structure protects everyone by locking in the future. The PPA locks in the revenue, the EPC locks in the design. But what happens if the world just fundamentally changes?
Exactly. What if technology outpaces the paperwork?
Yeah. Like imagine in 10 years, there's a massive breakthrough in power generation. Suddenly, our €2 billion wind farm is totally obsolete.
Right. The global cost of electricity plummets.
But our off-taker, the utility company, is still legally trapped in that power purchase agreement. They're forced to pay premium, above market prices for our wind farm's power for another 15 years.
They would be taking massive losses. It could threaten their own solvency just to honor a contract for a tech that the market has completely abandoned.
Exactly. So when the future simply outpaces the rigid legal boundaries we've drawn, who is actually left holding the bag? It really makes you wonder if these airtight contracts can survive the pace of human innovation.
It's the ultimate stress test for the entire project finance system, for sure.
It really is. Something to definitely think about next time you see a massive new infrastructure project being built.
If you're interested in the templates, please visit our shop. The link is in the description.
Thanks for watching. Please subscribe and see next time.